It's time for Ask Mike Mondays. Mike answers one listener's question every week. Here's Michael Becker and Paul Peebles.
Welcome to Ask Mike Mondays. I'm your host, Paul Peebles, National Underwriter for Old Capital. And joining me today, as always, the Mayor of Beckerville, USA, Mr. Michael Becker. How are you?
Hey, Paul. Doing well. How are you?
I'm doing well. Did the state of Texas pick you up this morning in their beautiful limousine with a big state of Texas seal on the outside of that Cadillac?
They have not. I'm still in my house, kind of getting back at it a little bit, but still largely stuck in the home. About to go on summer vacation, which will be nice. So I guess a vacation from my vacation of doing nothing. So well, at least it'll be a different scenery.
What happens in something like that? I mean, are you thinking about taking a vacation? And do you feel comfortable about leaving? Is that pretty?
Yeah, I do for sure. Right. So we're gonna drive to Florida for a week, and looks like my Hawaiian vacation lease is not canceled, certainly postponed, because the state of Hawaii is making you quarantine for 14 days. So that's going to be gone, and I'm sure a lot of people are crying for me right about now. But we'll try to get that back on the books before the year's over, hopefully, and get out of here. But yeah, just trying to make sure I get out of Texas in the summertime. It's hot here, so that's there's the snowbirds from the north, and I guess there's the sunbirds from the south. So us and Texas and hotter climates, we try to get the heck out of Texas, and especially July and August when the heat becomes unbearable for those 2 months, and I just try to go to cooler climates to escape the heat. So that's certainly something that we always do in my family.
Yeah, we asked Michael about what's going on because Michael, if you remember, is a longtime commercial banker for one of the largest banks in the country. He led his division for a number of years on apartment lending and retail lending and office lending and everything you can imagine that went into the lending platform. He was the man. So he did a great job with his company over at Wells Fargo. And then he made a decision to get from loaning money to owning real estate. And so he took all that knowledge and information and started to put together a portfolio. So him and his team over at SBI, they own lots of apartment units, I think 6,000 or so last time you told me, and about 24, 25 large apartment buildings in Dallas and in the Austin area. So we go to Michael to ask him the questions about what's going on. So we appreciate his time. And the reason why I call him the mayor and ask him about if the state has picked him up, because he owns so much real estate and he pays so much in property taxes that they should be picking him up in a freaking limousine every day because, that's just a lot of money you guys spend on the state. So talking about lots of money, this is the question that came in that I thought was an interesting one, talking a little bit about we've seen a lot of money that's being spent on the CARES Act and all the money that's being spent by the feds. What's going to happen with inflation? So the question that comes out is, Michael, tell us a little bit about what your take is on inflation when it affects commercial real estate.
I think it's going to be, very, very supportive of investing in commercial real estate. So I'm actually on the national debt clock. So this is going to be higher when this actually post right now is $25.5 trillion in national debt. So it seems like we're going up somewhere around 7-8 billion a day. So I think, obviously this might be a week or two lagging. So, we should be north of 25.5 trillion. So if you just want to go to usdebtclock.org, you can see what it is. So what's happened is they're just printing money like it's going out of style. So the revenues of the U.S. government, the U.S. Treasury are plummeting because obviously a lot of people have lost their jobs. They're not making the income. Plus they've delayed the payment of the tax date got extended from April 15th to July 15th. So a lot of those revenues just aren't being collected. They're giving, tax breaks a couple years ago. They gave a bunch of the Tax Reform Act that's reduced the amount of taxes people paid. Plus they're just, ramping up spending like it's going out of style. So, to have $25.5+ trillion of national debt with, seemingly like a multi-trillion-dollar deficit every single year. These words sound crazy coming out of my mouth, but I can't believe this, but I would assume probably that in the next, somewhere between 5 to 7 years, we might have somewhere around $50 trillion in national debt with a, multiple $1 trillion deficit every year. It just sounds crazy. And, And you couple that with the Federal Reserve stating that they're going to keep interest rates at or near zero for the foreseeable future, I don't see how there's any solution to or any outcome that doesn't include massive asset price inflation. So far, they've been seemingly able to keep consumer price inflation pretty tame for the last 10, 12 years when they've employed similar but less large percentages or dollar amounts policies where they, been, very low interest rates for a decade plus, big deficits and increasing the national debt. So I think it's going to be very supportive, Paul, for many years, because if you think that cap rates are kind of based largely on the amount of interest in a particular commercial piece of real estate, so how amount of capital flowing there. If there's a lot of capital chasing scarce number of apartment complexes for what we do, it drives people's price they're willing to pay up, which drives the cap rate down. And then two, people are able to pay more for the same piece of real estate if they have to pay much less in debt service, and the less debt service they have to cover, the more they're able to pay, which results in a lower cap rate. So I'm kind of in the camp that cap rate is going to probably be lower in the future, in kind of the mid to intermediate term, to probably even 10 years out. So 2 to 10 years from now, I expect cap rates probably be lower than they were, say, when we finished 2019 and began 2020. That's my personal crystal ball. So I think within reason and care, and in particular in the right locations and the right type of deals, if you invest in multifamily, I think it's going to be a great long-term investment. And I certainly have put my money where my mouth is, many times over. So that's kind of what I think is going to happen, Paul.
What are you seeing with the capital markets today? As an operator, are you starting to see Fannie Mae and Freddie Mac loosen up a little bit? What are you seeing?
Yeah, we're kind of ending May, beginning June as we record this, so it's starting to thaw out. I think the fear was in March that everything's gonna end. So all the lenders pretty much slammed on the brakes. All the lenders that were able to turn off their programs, which were basically the banks, the Life Co, the CMBS market, the debt funds, those all basically shut off. Well, Fannie and Freddie and HUD really have a mandate to loan throughout this, so they weren't unable to shut off, even though I think Fannie and Freddie wanted to turn off. So what they did is they basically removed any sort of exceptions to credit policy. They certainly added in some overlays and underwriting policies, like making people put up 12 months of PITI, principal, interest, taxes, and insurance reserves on top of the normal escrows. So they really just started putting some onerous restrictions in place to really try to slow down the pace of lending, which has been successful. But if you think about, we go back several months ago, we were talking in the third quarter, I think it was the third quarter of 2019, where Fannie and Freddie started hitting their cap. They really started, expanding their spreads to slow down. And then their regulator allocated each $100 billion to both Fannie and Freddie to go loan between the fourth quarter of 2019 and through 2020. And now that, we're almost halfway through 2020, they probably allocated, I think, somewhere around, about 30 billion. So maybe roughly a third of the money. And they only have 2 quarters to go. And the demand is kind of falling through the floor, because there's a lot of the transactions for the buying and selling a multifamily certainly down quite a bit. So they're way behind their pace. So we're starting to see, now that they have a little bit more confidence that collections weren't, not absolutely abysmal, that the revenue stream is a little bit more durable. So they're getting a little bit more confidence there, and that they're not just making a bunch of bad loans that'll just default. Plus, couple that with them being behind on their allocated money to go put out. Plus, we have historically low, almost unprecedented interest rates right now from the indexes, both from LIBOR, SOFR, and the 10-year Treasury, where a lot of these loans are priced off of, or basically all these loans are priced off of. The spreads are starting to come in. So I think that we're starting to see some light at the end of the tunnel. I think, certainly, I don't know if the answer is today, but, maybe 30 days, 60 days, 90 days from now, I think these debt terms are going to be much closer to what they were a few months ago than what they were the last month or two, Paul. What are you seeing? You're probably a little closer to that than I am even.
Pretty much the same thing. I mean, we're starting to see a little bit of a recovery, but I take that with a lot of caution, because I think there was David Moore had said on our conference call that we had probably about a month ago or so, that if you fell asleep in February and you woke up at the middle of May and you looked at collections, you'd look around and say, this looks pretty good. Nothing's really happened. And I agree with it. Nothing really has happened from collections for March, April, and May. So I think, we've seen a lot of distributions turned off within the partnerships. Some have turned back on a little bit, but I would just remain cautious that when the money runs out from the government to a certain extent for unemployment, I think we're going to see some crunching coming on in August or September if this economy doesn't get back to where it was to a certain extent and people don't get back to jobs and income flowing back into their pockets. So I think the government is right to kind of keep these replacement reserves in place a little bit longer just to see what that's going to look like for at least another 6 months. So I would tell you that I don't see the replacement reserves coming off the loans, but I do see them Fannie Mae and Freddie Mac being a little bit more clever how to put these transactions together. And then, there is some refinancing going on, but a lot of people that took out these loans 2, 3, 4, 5 years ago, they still have these huge prepayment penalties on them if they took a 10 or a 12-year fixed rate. So that yield maintenance penalty is something large to deal with. But if you did a bank loan or if you did a loan that is older than 5 or 6 years and that yield maintenance is starting to burn off, maybe it's time to refinance. But I will tell you just that we had the gentleman, J.P. Conklin, on talking about interest rates. I mean, we really don't see interest rates going up anything greater than where they're at right now. So I remember back when I first got into lending back in the mid 80s or so, we had interest rates at 12, 13, 14, 15, 16% on home loans and 21% just on student loans type of stuff, just incredible large interest rates. In fact, we just closed the loan, I think yesterday at 3.7%. So
for how long?
That was for 5 years with 5 years of a step down prepayment penalty. So it was like a 3-1 and done type of a deal on a pretty max small balance, but 3.71%, 12 months of replacement reserves. But, I think those rates are unbelievable. That's almost like free money, to be honest with you. But talking about free money, I mean, a lot of your loans that on your properties are just straight adjustable rates. And what type of rates have you been paying on some of these loans that you guys have?
We locked in. Unfortunately, when we started the career, we had an opposite camp, and I think I've kind of evolved my thinking along the way on kind of had a paradigm shift on how we structure these deals from the beginning of a career to now, and then what I thought the risk was from the beginning of a career to now on these loans. Because when we started, we did a lot of 10, 12-year fixed rate money and the fours, right? So anywhere from the kind of the high threes up was like the lowest we fixed to the high fours. Maybe the first couple of deals are probably in the low fives, in 2013 or so. But, generally speaking, we're in the fours for most of those loans we did. And then as we started going full cycle on these deals, we were realizing that we thought that we would get a loan, be in the fours, the rates would be higher, and we could sell a loan that had a below market interest rate, and that'd be accretive to our situation, and we get paid for having that loan in place. Well, the opposite happened was, not only did rates kind of basically stay the same, if not go down, but the marketplace evolved in 2013. You would get 1 year of interest only on a 10-year loan, and then that turned into 3 to 5 years on the interest only on these loans. So my loan was probably had a debt constant, which basically your principal and interest payment as a percentage of the loan balance. If I had a 4.5% interest rate, my debt constant would be 6.25%, give or take. When you start amortizing these deals. So that's coupled versus someone that could then borrow money at 4% interest only. At the time we're trying to sell it, so it made my loan a liability, and I couldn't pay my loan off without incurring a large yield maintenance or defeasance prepay. So what I thought was going to be an asset would turn into a liability, and I got the battle scars of tens of millions of dollars and lost sales proceeds, either due to lower sales price for selling on a loan assumption, or actually having to pay the yield maintenance or defeasance prepay. So we learned that lesson good. So a couple of years ago, started shifting and started taking more adjustable rate mortgages. And that way, is typically we're LIBOR plus a spread. And we started making that decision. LIBOR was kind of in the mid twos and got up, I think, to even in the low threes as the Federal Reserve was hiking interest rates in 2018. So as a result, the marketplace would take a lower spread because the index was up. So, last year, the first part of last year, we locked several loans. We had one at 156 over 30-day LIBOR. We have one at 1.58% over 30-day LIBOR. We have several in that 180 to 190 kind of over LIBOR range. So now that LIBOR is 17 basis points or something like that, and it's going to be there for the foreseeable future. I have multiple loans that have a 1 in front of their pay rate that are interest only. So, it's kind of like a paradigm shift of what you compare that to, say, a deal that was maybe 4.5% a few years ago, and the interest only burned off, and now we're amortizing. So my debt constant is 6%, let's call it, and I have a loan that's I'm paying say 2% interest only. If you think about it, for every dollar of outstanding debt, I'm probably paying 3 times the debt service on something that had a amortizing fixed rate in the mid 4s, and I am something that's interest only in the high 1s or 2% range. So at the time where our income is potentially impaired, or can be impaired because all our tenants are having or a lot of them having some job issues, it's just more important today to have the lower debt service. So it's the opposite was true. What I kind of thought 7-8 years ago was actually less risky to take the adjustable rate mortgage than it was to take the fixed rate mortgage, and we're being rewarded on those deals and punished on the deals with the amortizing fixed rate. So it's just kind of a paradigm shift of something I've kind of seen across my career. And talking about JP Conklin from Pinsford, his company sells rate caps is one of the things that they do. And you can buy an interest rate cap for basically next to nothing right now. I mean, it's very, very affordable. So you can hedge your interest rates. So you kind of get the best of both worlds. You get the adjustable rate mortgage that has us now paying, really low rate. And you can take out the rate risk by buying a really affordable rate cap. So that's kind of been the model we've gone down and the last several years. And it's certainly paying off, making that shift right now on many of the deals we did the last couple of years. So certainly something to think about, as we start putting deals together and, talking with Paul and the guys at Old Capital. If you're listening to this and think about putting a deal together, maybe kind of have that in the back of your mind and, not just go to for years we just did kind of the chocolate or the vanilla ice cream analogy, either go Fannie or Freddie, but now there's really a world of options out there. You can get strawberry or Rocky Road or whatever you want with CMBS or debt funds or life insurance companies and some of those products when they start coming back into the marketplace.
If somebody wanted to get more information about what SPI does, what's the best way to get a hold of you, and then tell everybody what the heck do you guys do?
Yeah, really the easiest way to find more information, simply go to the company's website, which is www.spiadvisory.com. That's SPI like spy. Advisory.com. There's a contact us form, fill that out, and we're always happy to have conversation, send out some more forward data about what we do, and get you added into our database. So when we start doing future opportunities, we can put them in front of you. So that's really what we most like to focus on is buying a high quality apartment complex that have we think are reasonable investments that we can go put some of our own money in and go out and syndicate the capital from other people as well. So that's kind of really what we focus on. And from time to time, we'll do what we call advisory services, Paul, where if you have, $5 million or more, you want to go invest and you don't know anyone in Texas and you want to kind of leverage our relationships, experience, and track record and, do a deal that way. We certainly help people out to get that done as well.
Again, one more time, what's the email address or the web address?
Just go to spiadvisory.com and fill the contact us. Click on contact us, and there's a form to fill out right there.
Sounds pretty easy to me. So again, that was Michael Becker. I'm Paul Peebles. Have a great day.